Hello, ladies and gentlemen, and welcome to Microsoft One Commercial Partner Cloud Growth and Profitability webinar. You have joined us today for the Selling or Buying Your Partner Business event series. My name is Siam, and I will be your moderator today. This web conference is going to be recorded on behalf of the Microsoft Corporation. If you do not consent to be part of a recorded session, please disconnect your browser now. Attendees can access the web conference on-demand recording at the same registration site within 24 hours. We encourage you to use the Messages panel today at any time to ask questions regarding the content that's been presented or to request support. To do so, please click on the Messages button at the bottom of your screen, type your question into the white box, and click on Send. We will also be using the Messages tab to post announcements to the audience. Our presenters today will be responding to questions at the end of our event, but please feel free to submit your questions at any time during this session. We will post 2 polling questions at the beginning of the event, so when a polling question appears on the left side of your screen, please select the appropriate response and click on the Submit button. With that, I do appreciate your patience during our announcements, and you will hear a brief pause while I start my recording. Hello and welcome to today's webcast. You've joined us for the Selling or Buying Your Partner Business event series, and we are presenting today our 3rd and final session titled Best Practices for Preparing to Sell Your Partner Business. Kicking us off today from the Microsoft, we have Ginny Oben, who is a Partner Channel Marketing Manager. Now it's my pleasure to hand you over, Ginny. You have the floor.
Wonderful. Thank you so much, Siam. And hi, everyone. I'm so excited to have you join us today. As Siam mentioned, I'm Ginny Hoban, and I'm on our OCP, One Commercial Partner go-to-market team, really focused on partner profitability. I'm so excited to have everyone here today for our last in this 3-part series. If you've missed either of the last 2 sessions, those are available on demand, so definitely go back and check those out and share those with your colleagues as well. But today, I'm really excited to welcome back Mike Harvath, as well as not 1, but 2 partners to the call. We've got Michael Kraner and Eric Wells here today. You know, we hear a lot of interest from partners about interest in selling their practice or just really wanting to understand potential valuation or what you'd even need to do to start thinking about selling your business. A lot of partners really aren't sure where to start with that process. So today, again, we have Mike Harvath here, who's an M&A expert, CEO of Revenue Rocket, and it's a company that helps support partners through M&A transactions on both sides, both on buying and selling. Today, we're really going to be focused on the sell side. And then we're excited to have 2 partners here today sharing very different stories, actually, about selling their businesses. So it's their real-world experiences and the best practices that they got from those experiences. So we're joined by Michael Kraner, who was a New York City MSP partner focused on SMB. He decided to sell his company a few years ago and actually decided to exit the company and exit the industry. Ended up using that money to actually go out and buy a sporting goods company. So excited to hear more from him about that as you're going to hear Mike refer to it, selling out opportunity. And then we're also joined by Eric Wells. Eric's actually a former Microsoft employee who then went off and grew a successful partner business. And he actually decided that he wanted to sell in. So he wanted to sell his business, but he wanted to keep working within that same business. So he sold to Paravita Solutions a number of years ago, and has actually stayed on and still works with Paravita. So following today's amazing content, we're actually going to reserve 15 minutes for Q&A. And those can be questions either for Mark or for either of our partners. You can go ahead and submit those at any time, and I will go ahead and moderate those when we get to that point. So before I hand it over to Mike, we do want to ask just a couple of quick polling questions. So you're going to see on the right-hand side of your screen, we've got a polling question up. Have you ever been involved in a sale in the past? So yes, I've sold a company. Yes, I was employed by a company that went through a sale. And maybe no, I've never actually experienced a sale before. Just going to give you guys a second. And then let's pull those up. Okay, so most people are saying they've never been involved in a sale experience before. Okay, so that's good to know. And a couple who've maybe been employed by a company during that time. All right, and we're going to move on to our second polling question, which is, are you considering selling your partner business in the next 12 months? So we've got, are you interested in selling your business and exiting the company? So that's termed as selling out. Are you interested in selling your business but staying with the company? So selling in. You're going to hear Mike talk more about these terms in a minute. Still considering your options, not really sure, but kind of thinking about it. And then, of course, not planning a transaction in the next 12 months, but maybe just here to learn a little bit more today. Let's pull up the responses. Okay, so we're a little bit all over the board, but most really just still considering your options. So great. Well, you're on the right call today for it. Okay, so with that, I am actually going to hand it over to Mike Harvath of Revenue Rocket to jump into the content for today.
Thanks, Ginny. Appreciate it very much. As Ginny mentioned, I'm Mike Harvath, President and CEO of Revenue Rocket. We are an advisory firm based in Minneapolis. And today we're talking about selling your business, sort of an advisor and partner's perspective. A little bit about us. We're the premier growth strategy, consultancy, and M&A brokerage firm in the partner market. We've been around 16 years. We've facilitated over 150 M&A transactions in that time and advised over 450 partner companies since our inception. We're focused exclusively on IT services companies. That's really our sweet spot. And all of our partners here at the firm have over 20 years experience in Microsoft partner businesses. A little bit about it's time to sell. When it's time to sell, when your business is at its glass ceiling. And many times partners feel that they've sort of been bumping their head against the wall, I guess quite figuratively and literally, in reaching a certain growth ceiling. What we found in our experience with partners is that you tend to have a certain infrastructure and skill set that will help to grow your business to a certain size. And it's difficult oftentimes to break through that glass ceiling without some sort of change. And that change can either be a strategy change or team change or maybe even selling the business. When it's time to sell when you have a clear organic growth strategy that focuses on the balance between growth and profit. This is an important concept. I think many people sometimes feel that it's time to sell when their business may be in a period of flux or one that maybe there's been downward pressure on the business and now they feel like it's time to sell. We think that's probably the wrong time to sell because you will not be able to optimize your return on investment and the value that you've built into the business over the years. The right time to sell is when revenue is growing faster than the market. There's different growth rates in different areas of the market, as you all know, and they range wildly from, an aggregate market year-over-year growth of about 2 to 3% to fast growth areas like business analytics and security, which are respectively growing in the 20th percentile year-over-year. So, kind of depending on where your area of specialization, technical specialization is growing, your revenue is growing faster than that benchmark. The optimum time to sell is when you achieved best-in-class profit. Process and vertical markets are well-defined. We talk a lot about, verticalization and specialization here at Revenue Rocket, and believe that the path to the promised land is focusing on a very finite set of markets vertically, and then a finite set of technologies from a specialization perspective. You're financially healthy and have little or no long-term debt. This is an important component. A lot of folks, look at their business and value it based on a multiple, which we'll talk a little bit about later. We've talked a lot about in this series. However, they don't take into consideration that their balance sheet, may be in a situation that carries a lot of debt. And those are direct deductions to value when the transaction occurs. In essence, when you transition the business over to a new buyer, you need to satisfy all of your debt so that there are no encumbrances on the assets of the business when it's transferred. So having little or no long-term debt gives you more options. Obviously, you're in a position to reduce your control of the business. However you look at it, you're going to be in a position of less control. For some people, that's a very good thing. Other people, maybe not so much. And so you need to be thinking about that. And then also that you have a desire to monetize your investment. For most Microsoft partners, this is your single largest personal asset. And there's a desire to reduce risk and to monetize that investment through the sale. A little bit about increased levers. These are the levers that increase the value of your business. They include, obviously, revenue growth. We talked a little bit about that, growing faster than the market. The second is kind of gross margin, right? And being able to drive above industry average gross margins, which nets out to net margin. Packaged IP is also a very important thing. There's a lot of discussion in Microsoft and a lot of great resources on MPN, the Microsoft Partner Network site about packaging IP. There's a variety of great advisors in the space that can certainly help you do that. It's something that is desirable by most buyers. Specialization, we talk about that. It can really be, this really should say specialization and verticalization. We think that intersection, like I mentioned earlier, is important, and we see it as a way to optimize value and increase your valuation. And then obviously your addressable market and how you play in that addressable market is a factor that can increase the value of your business. When we look at discount factors, clearly leadership transferability or lack thereof is a challenge as it relates to your ability to actually sell and or will impact your value. It's important to, and we'll talk more as we talk to Michael and Eric about their different approaches to their sale, whether that is a sell-in model, such as what Eric did with Pura Vida, or more of a sell-out model after a logical transition, which is what Michael did. And being able to have leadership transferability will help you be in a position to sell out. Obviously, management experience, deep management experience inside the firm is something that's important beyond just the leadership. And if it is lacking, we'll create a discount. Liquidity in the business gives you options. You have lack of liquidity in the business or the balance sheet is levered up. Certainly that will be a challenge. Your location. Your location is important and can be a challenge in selling the business depending on the profile of the buyer. And we've seen this impact marketability of certain firms that we've represented to the market and has made it a little bit of a challenge to get some of those deals done, although they've been completed. But it just means there are fewer buyers, which I think ultimately means that it could create a discount on your valuation. And then also how mature your offerings are is critically important. We'll go from there. So, essentially offering the level of offering maturity through wedges to, what we call sort of your core offering or full life cycle of offerings, all the way through a maintenance support or managed offerings. How mature those are and how well they're put together, or lack thereof, will determine whether there's a discount factor or not. How to make it all work, a couple things, preparing for M&A, obviously, M&A has to be part of a larger strategy, right? And I think and you have to think of it, kind of walk a mile in the shoes of the buyer if you're a seller, and how your firm can be part of a larger strategy. It's really part of the 1 + 1 = 3. And so, and then how you're selling your firm may leverage value-added services or new service lines, regions, or customer extensions in a particular buyer profile. So I think if you're looking to sell your business, it's critical to understand who is the ideal buyer what you would bring to that ideal buyer in what we often term this 1 + 1 = 3 sort of synergistic view. We think it's important to bring in a strategic advisor. We've certainly played that role, lots of times for partners, but there's a great group of advisors that do M&A advisory out there, and we think the perspective of an outside advisor is important. And then, clearly look for the better together scenarios, right? Complementary culture and value. It's really all about people first. In a tech services business, it's a people business, right? And you have to look at how those cultures complement each other, where the value is, and where there's some strategic value creation. The only deals that get done are ones that are win-win-win. They're win for customers, employees, and partners and shareholders, so maybe it's win-win-win-win. There's no deals that are win-lose that we've seen that get done, or if they get done, and we just haven't seen one, but if they get done, I suspect what will happen is that they will not stay done. They will come apart in the future. What to expect in the M&A process? Certainly, it's a complex process, right? And we look at it here both from an M&A advisor's perspective and from a sort of a buyer lens. But these same stops, if you will, on the process impact the seller, as you can imagine. And so there's levels of readiness, what the prospect list is of potential buyers, all that stuff is critical. And so, we put this up just as a point of reference as it relates to, as you're thinking about a sale, understand it's a complex landscape, and you'll want to be getting some advice on how to navigate it. A little bit about successful transactions. Really, they pivot around what we call a three-legged stool of M&A. It's around culture fit, strategic fit, and financial fit. When we look at culture fit, it's really about business philosophy, core values, customer care philosophy, and employee care philosophy. Strategic fits really can 1 + 1 = more than 2. It must do that in order to really make it work and meet everyone's expectations. There's got to be good business process alignment, and IP has to essentially line up, or there has to be a complementary nature to that IP. Sellers will typically receive 6 to 9 times trailing 12 months EBITDA in a transaction. That number pivots around, as we've talked about in other webinars in this series, deal structure primarily, as to whether it's 6 or 9 or whether it's 5 or 10 or whatever, has a lot to do with also the strategic impact of this acquisition or your business on a buyer. And you should keep in mind that all buyers will look to achieve a 20% internal rate of return or less than a 5-year payback, right? Pretty critical that occurs when time goes on. I'll just touch briefly on post-merger integration. Post-merger integration is critical. If you're speaking with a buyer who doesn't have a strong PMI plan or hasn't began to talk with you about post-merger integration before close, you should be concerned. This is where one of the 2 things that we've seen from our experience that causes deals to blow up is lack of post-merger integration planning. The other is really a lack of culture fit or a misalignment around culture fit. And with that, I'll turn it over to Michael Kraner. I'll be happy to advance your slides, Michael. So without further ado, you have the floor.
Hi, good afternoon, everyone. Thank you, Michael. So my name is Mike Kraner. I started my tech company in IT managed services based in Manhattan, New York City, supporting the New York tri-state area in 2001. And basically what we did was help companies leverage technology to be more efficient, more effective, and help them gain competitive advantages to drive profit. We didn't want to be a help desk or an IT company. We really wanted to help them be successful. So we try to brand ourselves as anyone can do IT, but we're giving you competitive value drivers to be successful. Wasn't always an easy business. We definitely had to learn a lot over the years from managed services, locking in contracts, going from box pushing to recurring revenue to being really successful. Once we decided to focus on M&A, we decided that we needed to have 3 years of good financials. And once we really focused on numbers, we were able to drive value for the company, and we received, we were recognized by Inc. 5000 as one of the fastest growing companies in the country. We were right in the middle of the list, which was a great honor. And then for 2 years in a row, we were on the CRN fast growth list. So that was something we were really proud of. And I sold the company in 2015, so just about 2 years ago, and 2 years and 2 weeks, but I'm not keeping track. So how did I prepare for M&A? The best thing I did was really just jump into my numbers. I always found as a IT CEO that sometimes we were reactive to the client's needs, so we were always focusing on the urgent but less about the important. And the important for me was really to getting to know my numbers. And as I grew as an entrepreneur from 15 years ago to today, I realized that my partners around me needed to grow as well. So I really needed a strong deal-making CPA, someone who understood EBITDA, someone who understood where I was going, and someone who had actually been through M&A. I did not have that person at the time, and fortunately I was able to leverage Mike Harvath and Reed Warren and his team to help me move forward successfully. I realized my local guy just knew tax, but there's a difference between tax and being a business CPA. Next thing I did was I secured my client base. I try to extend my client deals into locked fixed fee arrangements with predictable income, and extended the contract lengths. Really what the customers are buying, the buyer is buying, is your customers. So the longer the deal and the predictable revenue only adds to the valuation. As much as they were buying the contracts, they were also buying my staff. So when we went through the process, I wanted to make sure that my staff was stable and happy. While they were stable and happy, I did not let anyone know that I was thinking about selling. I thought that if that got out, that would put me at a strategic disadvantage with my buyer, with my customers, and with my employees. I think it creates uncertainty for everyone, and uncertainty for me equals the word danger, and I didn't want any part of that. So it wasn't easy to not share with people, but I felt it was the best strategic path forward. When your company's being sold, as much as it's about your staff, it's also about process and procedures. They're buying a company, and they're not buying necessarily you. I was choosing to go out of the industry for the most part. So that was really important to me, and I thought that was more about the value. I was selling ConnectWise, I was selling my RMM systems, I was selling my workflow processes, and really how we had a good fit for the company. We found a strategic partner that didn't really have a managed services practice, but had complementary project-based businesses that was significantly larger than us. So they acquired us to take on our systems, our workflow, our knowledge of managed services. We try to show year-over-year growth, which we were able to do, and a clear path for growth. I don't believe we were at our glass ceiling, but I felt personally that the business was harder for me to scale than I wanted to, and I felt that there were times just to move forward into a larger company. One of my concerns at the time was cloud and financial investment to move forward in that. In hindsight, we didn't need the financial investment, but I think it was a better opportunity for us. Our vertical was financial services and real estate, which was a strong play in Manhattan. And, those are customers that, not a question of can they afford us, but can they afford not to work with us? So that was a healthy vertical. As we went through the process, the question became constantly, Mike Kraner, why are you selling? So I, at the time, had another company called MSP CFO, which helps IT companies know their numbers in real time, which came out of my need of running my MSP. So I was known in the industry. I think that gave me a little extra credibility as not just an IT guy, but a numbers guy, and you have to know your numbers. And the best thing that I did, and I don't think it was just for exiting the business, but I think as an entrepreneur, one of my best experiences was hiring an M&A partner and going through the whole process. For me, I felt like this was the end of the road of being an entrepreneur, is the full life cycle experience. And coming across Mike's firm, who I knew in the industry, was one of the best things that I've done. For me, I found that it was kind of it's an up and down path selling a company, and there's some emotion involved in it. And I decided, for me and my personality, I didn't want to be involved with that. I want somebody to lead me. I know what I didn't know, and I knew there were people who could better do this for me, so I could focus on running the business and not hurt the business by looking elsewhere. It was worth every dollar. It was worth the investment of time and money. As I went through the process, I tried to reduce unnecessary costs, grow my EBITDA, and again, locked in client contracts. I'm going to repeat this: keep the deal confidential from all staff, partners, and clients. And as a seller, you want to understand your tax ramifications, because you're not just looking to sell a company, you're looking to make money. So how your taxes play out are really, really important. So what did I learn in the process? More than I can actually list on this page, but I would say take the time to understand the process. Don't get rattled at all. Rely on your M&A banker so you don't get rattled. Realize it's a negotiation. You want to sell high, they want to buy low, but this is business. It's a financial transaction. So when you put it in that picture, leave the emotion out of it. It's nice that somebody wants to buy you, but don't get too focused on that. Focused on the end result, which is a win-win-win transaction. Think through the potential blind spots and objections beforehand. When someone from the outside is reviewing your business, what negatives can they come up with? Or what do you not see in your business that someone else may see? And that might be recurring contract lengths, or having a high rent, or high fixed costs, or staff turnover. There's a lot of different things that could come up, but if you're aware of it, then I think everything can be managed. And I know through my process, Mike and his team helped me manage a lot of questions that came up. Don't focus on your weaknesses, play to your strengths. This was really important. Don't be arrogant, be a team player, sincere, honest, and committed. And I think that brand is your personal brand and stays with you throughout the whole transaction. When you talked about, opting in and opting out, well, I've definitely moved into new fields. I'm actually kind of in a unique position where I'm still in this space. So the company that acquired us was Access Point Technology Solution Group. I had a 1-year contract. Contract expired, but I'm still working with them almost 2 years later on a part-time basis. So I have that opportunity to benefit from this relationship while going after new entrepreneurial activities, where I've been very fortunate because I've been respectful. I've followed everything that I've said. I've been a team player, sincere, honest, and committed. And even after we met all of our earn-out and caveats that we had to honor and protect, I'm still going at them. I'm still fulfilling my role as if I was still the owner, to protect the clients and represent the customers and the ownership the right way. So that was something that was really important to me. It's the legacy that I left behind. And from day one, I really want to build a bridge between my customers, my employees, the acquirer company. And after 15 years, my customers had become my friends. The company had become my family. And it was really important to me just to really just one word: respect for everybody and everything. This is a great time to be a leader. The transaction is about the people, but everybody needs leadership, especially in the face of uncertainty. And when I had the up and downs of the valuation, they want a lower price, I want a higher price, we're being pushed back, the terms of the deal may change. Always just took a deep breath, went back to Michael and Reed. I didn't rush to judgment. And I think sometimes if you're quick to anger or quick to show emotion, people are always watching. So I think you just have to stay composed, be positive, and really take the time to listen, assess, and then make a decision. And really, I think Mike, as my M&A partner, really helped me get through the personal side as opposed to just the financial side and the legal side. One other lesson I learned was that having centralized financial and legal guidance was really helpful. So Mike gave us a team. If I had brought in my own local attorney, who focuses on, litigation, for example, I don't think he would have been as well equipped to help me through the transaction. And I think it would have made it more difficult. That once you get the team rowing in the right direction, it's important to stay in that right direction. And just to close, to go back to what Jeannie said, how did I make the transaction? I always felt that I was more of an entrepreneur than just a CEO of an IT company. I love the technology and adding value, but over 15 years I got to be really an entrepreneur working on many teams, although they weren't my companies, because that's what I felt I did as running a managed service provider. So having 2 children, I wanted to find a way to share sports with them, create a healthy lifestyle. So I created a company called My Backyard Sports, where we help companies, that's what I used to say in IT, where we deliver high-end sports facilities to people's homes, backyards, and driveways. But I'm able to apply a lot of what I've learned in the IT space of systems, processes, leveraging technology, what I did for my customers, now I could do for my own business, and take an industry where there's traditionally low technology and apply that with my new offering. Hoop Industries is an intellectual property play that has similar values to My Backyard Sports, but we had an idea to create some intellectual property and take it to the market around basketball and health and wellness. So we're doing those 2 things. My employer, Access Point, is very flexible in what I'm doing. Fortunately, I'm winning or doing well with Access Point, with My Backyard Sports. Hoop Industries is doing nicely as well. And then my other company, MSP CFO, which I founded running primary support, which was really valuable. And I think without MSP CFO, I'm not sure I would have known my numbers as well. And I'm not sure I would have been able to make it onto the Inc. 5000 list, which helped me sell the company. I sold control of that company recently to my co-founder, Larry Coburn. And those are the things that I'm interested in today. But going forward, everything I learned in M&A, I think has really helped me feel more confident as an entrepreneur. And I think it's one of the better experiences I've had in business. And it's not just because it was a successful transaction. It's just because I learned so much and was able to close my life cycle of as an entrepreneur for the first time. And now I'm looking to do it again. So thank you for the opportunity to join the panel.
Great. Thanks a lot, Michael. I appreciate your story and your time and sharing it with the audience. With that, I'll turn it over to Eric Wells. Eric, you have the floor.
Great. Thank you very much. I'm Eric Wells. I'm a vice president at Pariveda Solutions. Pariveda is a technology consulting firm with a head office in Dallas and offices in 10 other cities in the United States. We specialize in designing and developing custom software applications for corporate clients. It's a firm is about 500 people in the United States, and most of our work involves writing custom software. I had started a company called Softagon Corporation in San Francisco in 1997 and ran that firm for 14 years before selling it to Pariveda in 2011. And after selling the company to Pariveda, I continued to work for Pariveda as a vice president. At Softagon, we also specialized in designing and developing custom software for corporate clients. So our business was directly in line with Pariveda's business at the time that we first started talking with them. I had started Softagon alone and basically bootstrapped the company without any outside investment and without any debt, and just hiring software developers to bring on staff to expand the business and to again to develop custom software. Our primary focus was in what I call the alternative investment world, and that includes hedge funds, private equity firms, real estate development and real estate investment firms, as well as some of the large investment banks. And we, over the course of, I guess about 10 years or so, we developed a strong reputation as being very strong in our ability to design software applications that were used in the investment world. So in investment modeling, trading applications, portfolio management applications, order management systems, things of that nature. And we developed a couple of very close partnerships with Goldman Sachs and Morgan Stanley, from which we got a lot of referrals. So from 1997 up through 2008 timeframe, the company grew up to 30 people. We had an office in New York and an office in San Francisco. And in 2008, we were hit by the financial crisis that occurred then. And it was a bad time for our business because we were so much invested in the investment and finance space. And there was a period of, about 3 or 4 weeks in the spring of 2008 when I got phone calls from some of our largest clients telling us to essentially stop work on major projects. And so we immediately scaled back quickly, and we had to let go, unfortunately, because just things were not going well in the market. And we scaled back to about 16 people, so we nearly reduced our size by half. And by the end of 2008 and going into 2009, I started to rethink the business. I had high aspirations of growing the business initially to a large consulting firm. And with this event occurring in 2008, it occurred to me that in order to do that, we would have to either get some outside capital to really shore up the business and to make some investments in the business, or try to partner with someone else that was larger than us and that could basically help fund growth. And it was around that time that I'd actually had been speaking with Mike Harvath a few times over the years. I'd never really thought about selling the business, but faced with the situation in 2009, that became a very viable option at that point, considering the circumstances. In working with Mike, it was a very good experience. We basically looked at our company, identified some target companies that were in similar businesses that we thought might be a good fit. We had a number of different conversations with some of those companies, and then Mike introduced us to Paraveda. And the conversations with Paraveda went extremely well. I flew out to Dallas and met with the CEO, Bruce Ballingy, as well as some of the key staff there, Carrie Stover and John Humphreys. And we determined that there was a very good fit, at least in those initial conversations, between our firm, Softagon, and Paraveda. It seemed as though we valued the same things, that there was a very strong cultural fit. We both of our firms were very much interested in technology and in software development. And we also placed a high level of value on our people, because a consulting firm that specializes in software development, you are your people, you are the talent that you have on staff. And so we entered into discussions with Paraveda, and it was a lengthy process. I think from the time that we first started talking until the time that the acquisition was final was about a year. I wanted to make sure that my staff was fully bought in and was comfortable with joining Paraveda, because again, the value that we were going to realize from Softagon becoming a part of Paraveda was going to be highly dependent upon the people that were at Softagon staying with the firm post-acquisition. Because obviously, if you go through an acquisition and all your people leave, then the company, the buying company, is going to be, left with nothing and wondering what happened. So we had people from Softagon fly out to Dallas to meet with people from Paraveda, a lot of discussions back and forth, all very positive. And so by the beginning of 2011, we started to enter into a period of due diligence and reviewing client contracts, reviewing all our books and records. I'd made a big effort over the years, especially working in finance, to make sure that all of our books and records were completely clean and that they were very clear. We spent a lot of time modeling the acquisition with Paraveda, where we share Excel models to basically show that we were in agreement with what a post-transaction company would look like. We also, as Mike mentioned earlier, there was some clear advantages to both sides. One, from our side, we were going to be part of a larger organization that had more capital, that was already in 7 or 8 cities, that would help us to further develop our people and to further fund the growth of the company. From Paraveda's side, it just so happened that Paraveda did not have an office in San Francisco, nor did they have an office in New York, and those are obviously two key commercial areas that if you're doing software development consulting, you want to have an active office in. So from that perspective, there was a very good fit between both of our firms as we went into these discussions. As far as preparing for the actual acquisition, I spent a lot of time thinking about my own personal goals as well as the goals of our company. I was very open in talking with my staff about the acquisition and about what it would mean to the company. We didn't want to divulge this information to our clients because the nature of the work that we did, we within our firm held knowledge and of some very vital pieces of custom software that were in place in some rather large hedge funds that basically we had to develop to implement trading algorithms and things of that nature. And so there was a high level of dependency of some of these firms on our staff to be there to work on these applications in the future as systems changed. And so we did. We didn't tell our clients right away. When we got into the spring of 2011, and it became apparent that the the acquisition was going to go forward, I then picked up the phone and started calling clients and telling them what was happening, and also reassuring them that the staff that we had in the Softagon offices were going to remain in place, and that this knowledge that we had of their internal systems was going to be preserved so that we could continue to support them and work with them going forward. Let's see. The amount of work involved in doing the M&A there was quite a bit of work, mostly in the due diligence period, in reviewing all the financials and going through all the contracts. But all of our books were in order, and so it actually was very clear there were really no issues that came up that caused any alarm. We were very open about everything, had put everything out on the table, no surprises. Wanted to make sure that we were very transparent and very clear about the nature of our business and the nature of our client relationships, and as well as all of our employees. I had come up with a number on my own of what I felt the company was worth. Paraveda came up with a number, and those numbers were very close. And so that was very good from a negotiation perspective and making sure that the deal moved forward. As far as things that I learned from the M&A process, and this was the first time that I had gone through this type of process before, a culture fit is very, very important between the two companies. And there was concern in the beginning because our main office was in San Francisco. Paraveda was in Dallas. There was some concern from some of my staff that, hey, a Dallas-based company is going to have a completely different culture from San Francisco. And I saw that as being sort of an unfounded bias. And so when we got people from both companies in the same room talking to each other, we realized that indeed it was an unfounded bias, that there were a lot of very strong cultural elements that we had in common. Again, as I said before, no surprises, don't withhold any information, put everything out there on the table, be patient. From my perspective, and different companies, different types of companies have different ways to approach this, but I was very open with my staff and talking to them about what we were doing. I felt that it was very important to have them on board, considering the knowledge that they had of the systems that we were developing, that if I didn't have their buy-in and their full commitment to this, that it wasn't going to work. So I was very open in talking to them. There is, as far as forecasting and developing models that predict what the future revenue stream or EBITDA will be of a combined company. There is, forecasting is an art, and there's a lot of questions regarding the validity of numbers that might be generated from a forecast model in an Excel spreadsheet. I really only believe forecast models going out for about a year. After a year, numbers become very questionable. So I really just focused on what we would be able to do in the year after acquisition, and then hope for the best after that. Make sure you understand the value of your own firm and what you're willing to negotiate. Luckily, again, the value I came up with was very similar to what the value Paraveda came up with, and so the negotiation on that part was pretty straightforward. And then I'm a big believer in modeling transactions because that's in line with the work that we do, and so I developed a number of different models that basically showed the value of my firm as well as what the potential outcome of the transaction would be. And so, and in summary, it was a very, very, very positive experience. It was great to work with Revenue Rocket and Mike Harvath, and going through this experience, they brought a lot of knowledge and a lot of information to the table that was very helpful to us in making this a successful transaction. And I'm still with the company today. I think Paraveda is a great company, and it's really great to continue to be working for them. And that's all I got.
Thanks, Eric. Appreciate it very much, and a great story. Thanks for sharing it with us. Takeaways from today's presentation. One is definitely be clear about your personal and business future. I think having a vision for what you would like post-transaction and post-integration is critical. I can't overemphasize this enough. Oftentimes people will enter into a transaction and say, hey, we just want to sell, but they haven't really thought about what does it mean post-transaction for them. Analyze sort of your personal and professional goals and get in alignment with that. Be ready or get ready to sell, pretty important. We've talked about what readiness means for both Michael and Eric and some other ideas early in the presentation. Definitely be getting in alignment on that. Know what you bring to the table in an M&A conversation, and the 1 + 1 = 3 is very critical in order to architect and articulate your value to a potential suitor. Obviously, profit drives value and gives you options. So the more you can optimize profit ahead of the transaction, the more valuable your firm is going to be. Make sure you clean up your balance sheet. Clearly, having debt on the balance sheet or other issues on the balance sheet certainly can be worked through. It's not like if you have debt that is a deal killer. It certainly is not. It's just that you're going to want to have as clean a balance sheet as you can moving into a transaction. And then obviously lean on your advisors. It's not an easy path, right? There's been many times M&A has been quoted as the most unnatural act in business. And the reason for that is just none of us, other than those of us that are in the industry of doing transactions, do it every day, right? As a business owner, as a partner, you may do this once in your lifetime, or even some of the most experienced practitioners only do it a handful of times. So it is a very unnatural act, and I think leaning on deal makers and lawyers and accountants that have that experience is critical. And then just go do it. We are offering a special offer from Revenue Rocket for the audience. It's an M&A readiness review. If you're wondered if you're ready, or wondered about the value of your firm, or wonder who an ideal buyer profile would be, certainly we can help you with that. And if you have some interest, feel free to send me an email at the email below. We are offering it as a 50% discount, so normally it's a $10K investment. We're offering it for $5K, and I'm sure that you would learn a lot about your business, your value, and ultimately who an ideal buyer may be. And with that, I'll turn it back to Ginny for questions.
Wonderful. Yeah, so we've got some great questions in, but please, keep them coming, folks. One that just came in, which I think is great. Could you expand on why you need to be clear on what your personal and business future will be? Why is that so important?
Well, I think otherwise you're going to wonder why you're doing this, right? I think you have to have clarity about life post-transaction to provide a goal on the horizon for you. There's hundreds of things that you'll need to negotiate as part of a transaction, and they're difficult. And I think without having a clear, it's the old adage, right? Without a roadmap, any road will get you there. The same thing applies to sort of post-merger or post-sale future for you personally. It's critically important. I don't know, Michael or Eric, if you have any words of wisdom on that area.
Well, this is Eric. From my perspective, I knew that I wanted to continue working with the company. I wanted to continue working with the clients that I had worked with over the years that I'd run Softagon, and I thought it was a very important negotiating point. A lot of the key clients that we had at Softagon, I had negotiated personally and had personal relationships with some of these people, and I wanted to be able to go to Bruce Ballingy and Terry Stover, the people I was negotiating with at Paraveda, and say, I'm going to stick around. I'm going to be a part of this. I'm going to help you grow your company further, and I'm going to help and bring along these strong client relationships that I have. So I think it was important that I knew that was my goal, and I was going to continue to do that, and that was an important part of the negotiation. Obviously, if I wasn't going to do that, it was important that I was going to be very transparent with them and say, look, after you acquire this, I'll stick around for a little bit, but then I'm going to be gone. I think it's very important to be able to represent what you want personally out of this as part of the negotiation process. At least it was for me.
Yeah, I would also add that Michael, let me just interject for a second. It does obviously impact financial modeling as well, right? Typically the costs associated with you and when you'll be there or not be there impacts the modeling. And I think being transparent with a buyer about your personal intentions is critical. It's the easiest way for you to get there. Michael?
Yeah, no, I was going to agree. I was transparent in what I was looking for, but I was very open, and knowing what I wanted personally, I was able to better align what I wanted to do with the business.
Thanks, guys. Yeah, it's such a key thing to know upfront, so you can make sure that you are having those honest conversations as you go into the negotiations. So we've got another question that I think is really interesting. So we've got a partner who's saying that they've got a really great development tool, but they don't really have much marketing experience on their team. So they are interested in eventually, maybe merging with another company or selling. But you guys have all mentioned that it is a process and it takes time, and they're kind of at the end of their rope in terms of funding and being able to stay in business. Do you guys have any recommendations for them on what they can do in the short term to make sure that they can keep their business going as they're maybe looking towards a longer future of merging or selling their business?
Certainly not knowing the specific situation, it is all about being able to survive to fight another day. And I think profitability is key there. Right-sizing the business to get to profitability will give you runway to make decisions and find a suitor. I think beyond that, clearly there are some early-stage investors that, particularly companies that have built IP, that are out there. I would tell you they tend to look more like friends and family investors or people who are more interested in, you probably already know who that investor is, would be my advice. And I would look to them to see if there's a way or a compelling proposition for you to give you enough runway to look at a potential transaction. Eric, Michael, I don't know if you have any other advice on that, but.
I would. This is Eric. I would concur with you, Mike. If it is a company based off of a product and development of that product is requiring additional capital, and that capital is running out, then obviously, if the value of the company is around that product, it's necessary to keep the business going until you can negotiate a deal, and then also to be able to demonstrate, obviously, what the value of that product is and what it could be if it had greater investment.
Wonderful. All right, I think we've got time for just one more question. I had a question actually for Eric, specifically around, you mentioned that you had a lot of contracts, that the long-term contracts, that was kind of part of the benefits of that deal with Paraveda. I know now with the cloud, some of those contracts maybe aren't as long-term. How would you think about making sure that you do have that longer-term contract, or how do you convince a buyer of that longevity of the work and those customer relationships?
Well, that's a good question, because most of our contracts were actually not long-term. The long-term nature of the relationships that we had with our clients was not explicit. It was more implied by virtue of the fact that we had done work for many of these clients for many, many years, and that we essentially held the intellectual capital or intellectual property of some of these systems that we had designed and developed for some of these clients, and that some of these clients had become very reliant on these applications for the running of the firm. So if you develop a trading application that implements a particular trading algorithm for a hedge fund, then there's an implied reliance on the person who wrote that code, because generally code is rather complex and it's hard to transfer that knowledge to another software developer. That was actually one of the things that we were struggling with, and that we were trying to figure out a way that we could develop a longer-term service model with some of these clients that would transfer, rather than doing one-off project work and basically doing support work on some sort of a time and materials basis, that we had some sort of basically a subscription model where our clients would subscribe to our continued support for some of these applications. And we were small, and because of that, we did not have leverage in negotiating some of those, in negotiating that sort of subscription model. And that was another sort of reason for moving forward with the acquisition, to try to hook up with a larger firm that had greater leverage in doing some of these negotiations, to try to get more of a subscription or a recurring revenue-based model in doing software development work for some of these firms. So I don't know if that answers the questions, but that actually was an issue that we were grappling with prior to the acquisition.
Yeah, no, that's fantastic. All right, well, that is all the time we have for questions today. I want to say a great big thank you to all of our presenters for sharing your stories around the sales that you've been involved with. For folks who are, enjoyed the content that we've presented over this three-part series, we do have a couple of places that you can go to continue to learn more about cloud growth and profitability. We've got 2 community groups. We've got a LinkedIn group and a Yammer group. We really encourage you to go and sign up there. It's an opportunity for you to continue to ask questions to us, to each other, to your peers. And we'll also post up more resources and opportunities, programs that we're going to have coming out over the next few months. So that's a great place to make sure that you're up to date on everything that we've got available. Of course, if you missed one of the sessions, they're all available now to catch up with on demand. As always, we do have a survey today. It is in the messages tab on the panel. We'd love to hear your feedback on this. This is one of the first times we're doing this type of session, so we're very excited to do more of this type of content around cloud growth and profitability, and your feedback on what you liked, what you didn't like, what you'd like to see next in terms of topics is going to help us make sure that the next series we do is just exactly what you need. And of course, as always, we do have a ton of other profitability resources. I highly recommend that you take a look at Revenue Rocket's website, as well as reaching out to Mike via email to learn more about the services that they can offer, including that special offer. And with that, I know that we're at the top of the hour and is, getting towards being a holiday weekend. So I'll go ahead and let everyone go at this point. Again, thank you so much for joining. Thank you to our speakers, and I hope everyone has a wonderful holiday weekend.
Thank you.